China's whole economy is about to crash, causing the biggest recession in history. Recent economic indicators from China are showing the nation's severe fragility. Although the Chinese Communist Party is attempting to revive the economy, the reality has already been revealed. Cathie Wood, who oversees nearly $20 billion, was quick to recognize the suffering the world was about to experience. According to economists, the US GDP growth is now outpacing that of China for the first time in nearly 50 years. What is actually happening in China then? This video will explain China's worrying predicament and the startling statistics pointing to the country's impending collapse. Following the opening of China's economy in 1978, the nation saw extraordinary rates of growth. The GDP increased by an average of 10% annually, greatly enhancing the standard of living for Chinese people. Over 800 million people were lifted out of poverty. Healthcare made significant advancements. Education was given top priority, and technical advancement quickened. All economists regard China as a manufacturing powerhouse thanks to its unmatched growth. But as you are all aware, there is no such thing as a free lunch. China's unmatched affluence was caused by its expanding obligations as the economy expanded. Loan borrowers saw a quick increase in their net worth, which encouraged others to do the same and accelerated economic growth. This led to an increase in loan borrowers among Chinese citizens. The cycle symbolized a positive feedback loop that led to exponential growth in China. The model is effective. China's debt has been increasing for many years, but it has reached an unsustainable level. China's government debt to GDP ratio has risen to over 66%, which has grown over the many decades of growth. The total public debt in China has also followed this trend, reaching over 300%. This is nearly 60% higher than the global rate of debt to GDP and is almost double the US non-financial corporate debt to GDP. China's recent problems are showing that such a big number of liabilities is unsustainable. China's been making an effort to adopt the zero-COVID policy. China's government has a straightforward goal of having no COVID cases thanks to the zero-COVID policy. The only way to come even close to achieving this objective is to impose strict laws that have negative economic effects. Due to China's stringent laws, banks and economists worldwide have been reducing their GDP projections for the country. More crucially, China's crackdown on excessively leveraged businesses may start a negative feedback cycle, the reverse of the positive feedback loop we discussed previously. The economy slows down as a result of people defaulting on their loans, which encourages additional defaults and further sluggishes the economy. Real estate is one of the sectors that the presidency has been implementing a wide range of regulations for this campaign. Real estate prices are the definition of uncommon prosperity, and investors have made an excessive amount of capital appreciation from rising property prices. By adopting new property taxes, Xi is aiming to crack down on this. The Three Redlands policy is another policy that Xi has been cracking down on in real estate. Housing prices are falling at incredibly fast rates as a result of the Three Redlands cap on the amount of debt that developers can incur. A similar decline in new house sales volume is also being seen. Early May 2022 saw a 33% decline in new home sales in 23 major small cities. Since real estate makes up 25% of China's GDP, a 33% decline in home sales would translate into a 9% decline in China's GDP. While the US Federal Reserve has been raising interest rates, the Chinese government is aware of the company's impending disaster and has been doing everything in its power to stop a further collapse. To save its economy, China's government has been lowering interest rates. The current prime rate for family and business loans in China is 3.7%. With time, it's only anticipated that this number would decrease even further. The nation just reduced its prime rate for 5-year loans by the most since 2019. Contrary to this, China's economic collapse could trigger a severe recession that would affect the entire world. Most investors view this crash as an isolated failure that won't affect other countries. The US Federal Reserve is raising interest rates and boosting the currency's purchasing power, which has a direct negative impact on the value of the yuan relative to the US dollar. China's declining purchasing power is a result of its currency's depreciation. Since China contributed more than 18% of the world's GDP in 2021, a sudden decline in the country's economy would weaken the whole world. Add to it the fact that Europe's economic development is slowing, and it's evident that we're in a worrying situation. Cathie compared the Fed's decision to raise interest rates to playing with fire, since it might make international problems worse. For the first time since 2019, the US bond curve has inverted, which suggests that a recession may be on the horizon. When the interest rate for a short period of time is higher than the interest rate for a longer period of time, the yield curve for 10-year Treasury bonds will be inverted. This suggests that the risk is larger in the short term than the long term. Bond investors anticipate tremendous pain, to put it another way. Most of the time, an inverted yield curve signals the beginning of a recession, and given the terrible financial situation in Europe and China, the Fed appears to be playing with fire. International economies are currently exceedingly vulnerable, and if one crashes, the US economy will cause unimaginable havoc in all the other economies. The last global recession, in which a wide range of nations faced economic weakness, occurred in 2008, but that recession was not as severe as the one we're currently experiencing. The rest of Asia, Australia, and Africa did not see significant declines in their respective GDPs during the global recession of 2008. China's GDP was still growing in double digits. Unlike 2008, the bulk of Asia, Europe, South Africa, Australia, and America are suffering in the current circumstances. There are many graphs about the Chinese economy, but the figures may be fake. China is infamous for providing fake economic statistics that hide financial crises and overstates development. Several Chinese cities have admitted out loud to fabricating economic data. One industrial city in northern China, called Baotao, publicly revised its economic report as a result of the additions. Another city, dubbed the Chinese Manhattan in 2016, inflated its revenue by 33%. Cathie thinks that if we saw the real numbers in China, there would be even more massive sales declines in the property sector, and that could ultimately lead to lower oil prices in the short term. This type of false reporting could mean that China is already in a recession, but we just don't know it yet. How can investors prepare their portfolios to weather this downturn then, knowing all this information? Holding cash is one easy method to keep afloat, but inflation will erode your savings, making foreign investing unfeasible given how badly both Asia and Europe are doing. The US financial markets are still in the best position compared to the global markets, despite the fact that the US dollar is experiencing significant inflation and is still holding up well. Investing in the US market is one way to protect your portfolio in the coming months. The dollar index measures how strong the dollar is in comparison to other currencies. Despite significant inflation over the previous year, this indicator has been rising. Investing in gold may be a great hedge, but gold prices may decline if inflation significantly slows. Every asset has drawbacks, and that's the key point. Diversification among the best assets would be the best strategy in this situation to reduce volatility while maintaining favorable returns. One example of diversification would be to hold 25% in cash, 5% in gold, 5% in Bitcoin, 40% in exchange-traded funds, and 25% in individual equities. Even though such a portfolio may not yield the highest returns, it will nevertheless provide you with enough money to buy a dip and generate long-term profits. This ends the video for today. Comment here with your thoughts on China's coming recession. Do you believe that China and the US will both be hit? Please hit the like and subscribe buttons if you enjoyed the video, and we'll see you in the next one.